Hi, hello, welcome to all of you. This is Dr. Manjunath N, Assistant Professor from Department of Commerce and Management Studies, Government First Grade College, Srinivaspur. This session is particularly designed to BBA 5th semester students of Bangalore North University. In this session, we are going to discuss the subject called the investment management. The topic for this session 36 is strategies for managing a bond portfolio. That is the bond portfolio management strategies, however you can call. Before going to discuss about this particular topic, let us know which are the concepts that we discussed in the last class. We have discussed about the bond portfolio management strategies, an introduction part in the previous class. The main learning objective of this chapter is to provide an overview of portfolio management strategies, portfolios, revision and rebalancing, and apply the various measures for evaluating a portfolio. After attending this particular session, the students will be able to explain or understand the bond portfolio management strategies. To the causal observer, bond is investing would appear to be as simple as buying the bond with the highest yield. While this works well when shopping for a certificate of deposit at the local bank, it is not that simple in the real world. There are multiple options available when it comes to structuring a bond portfolio, and each strategy comes with its own risk and reward for trade-off. The four principal strategies used to manage bond portfolios are: number one is passive or buy and hold, index matching or quasi passive, immunization or quasi active, dedicated and active. Passive investing is for investors who want to predictable income, while active investing is for investors who want to make bets on the future. Indexation and immunization fall in the middle, offering some predictability, but not as much as buy and hold or passive strategy. Passive bond management strategy. The passive buy and hold investors is typically looking to maximize the income generating properties of bonds. The premise of this strategy is that bonds are assumed to be safe, predictable sources of income, but and hold involves buy and hold involves purchasing individual bonds and holding them to maturity. Cash flow from the bonds can be used to fund external income needs or can be reinvested in the portfolio into other bonds or other asset classes. In a passive strategy, there are no assumptions made as to the directions of future invest rates, and any changes in the current value of the bond due to shifts in the yield are not important. The bond may be originally purchased at a premium or a discount, while assuming that full par will be received upon maturity. The only variation in total return from the actual coupon yield is the reinvestment of the coupons as they occur. On the surface, this may appear to be a lazy style of investing, but in reality, passive bond portfolio provides stable anchors in rough financial storms. The immunize or eliminate transaction cost, and if originally implemented during a period of relatively high interest rates, they have a decent chance of outperforming active strategies. One of the main reasons for this stability is the fact that passive strategies work best with very high quality, non callable bonds like government or investment grade corporate or municipal bonds. These types of bonds are well sustained for a buy and hold strategy as they minimize the risk associated with changes in the income stream due to embedded options which are written into the bonds convenience at issues and stay with the bond for life. Like the stated coupon call and put futures embedded in a bond allow the issue to act on those options under specified market conditions. For example, a company A issues $100 million in bonds at 5% coupon rate to the public market. The bonds are completely sold out at issue. There is a call feature in the bonds covenants that allows the lender to call or recall the bond if rates fall enough to reissue the bonds at lower prevailing interest rate. 3 years later, the prevailing interest rate is 3%, and due to the company's good credit rating, it is able to buy back the bonds at predetermined price and reissue the bonds at the 3% coupon rate. That is good for lender but bad for borrower. Lendering, bond laddering in passive investing. Ladders are one of the most common forms of passive bond investing. This is where the portfolio is divided into equal parts and invested in laddered style maturities over the investor's time horizon. Indexing bond strategy. Indexing is considered to be quasi-passive by design. The main objective of indexing a bond portfolio is to provide a return and risk characteristics closely tied to the targeted index. While this strategy carries some of the same characteristics of the passive buy and hold, it has some flexibility, just like tracking a specific stock market index. A bond portfolio can be structured to mimic any published bond index. One common index mimicked by portfolio managers is the Barclays US Aggregate Bond Index. Due to the size of this index, the strategy would work well with a large portfolio due to the number of bonds required to replicate the index. One also needs to consider the transaction cost associated with not only the original investment but also the periodic rebalancing of the portfolio to reflect changes in the index. Immunization bond strategy. This strategy has the characteristics of both active and passive strategies. By definition, pure immunization implies that a portfolio is invested for a defined return for a specific period of time, regardless of any outside influences such as changes in interest rates. Similar to indexing, the opportunity cost of using the immunization strategy is potentially giving up the upside potential of an active strategy for the assurance that the portfolio will achieve the interested desired return. As in the buy and hold strategy, by design, the instruments best suited for this strategy are high grade bonds with remote possibilities of default. In fact, The purest form of immunization would be to invest in a zero coupon bond and match the maturity of the bond to the date on which the cash flow is expected to be needed. This eliminates any variability of return, positive or negative, associated with the reinvestment of cash flows. Duration of the average life of bond is commonly used in immunization. It is a much more accurate predictive measures of the bond's volatility than maturity. A duration strategy is commonly used in institutional investment environment by insurance companies, pension funds and banks to match the time horizon of their future liabilities with the structured cash flows. It is one of the soundest strategies and can be used successfully by individuals. For example, just like a pension fund would use an immunization to plan for cash flow upon an individual's retirement, that same individual could build a dedicated portfolio for their own retirement plan. Active bond strategy. The goal of active management is maximizing total return. Along with the enhanced opportunity for returns, obviously, comes increased risk. Some examples of active analysis, active styles includes interest rate anticipation, timing, valuation, and spread exploitation and multiple interest rate scenarios. The basic premise of all active strategies is that the investor is willing to make bets on the future rather than settled with the potentially lower returns as passive strategy can offer. There are many strategies for investing. In bonds, investors can employ. The buy and hold approach appeals to investors who are looking for income and are not willing to make predictions. The middle of the road strategies includes indexation and immunizations, both of which offer some securities and predictability. Then there is the active world, which is not for the causal investors. Each strategy has its place and when implemented correctly can achieve the goals for which it was intended. The returns of bonds are influenced by the number of factors. Changes in interest rate, changes in the credit rating of the issuer, and changes in the yield curve. A bond strategy is the management of bond portfolio either to increase return based on the anticipated changes in these bonds pricing factors or to maintain a certain return regardless of changes in those factors. Bond strategy can be classified as active, passive, and hybrid. Dear friends, there are so many even references are there. You can go through the references. And before that, let us discuss a few questions to understand this particular session. So I have a few questions to ask you, all of you. The first question is, the passive buy and hold investor is typically looking to dash the income generating properties of bonds. There are four options are there. Number one, minimize. Option B, maximize. Option C, estimate. Option D, calculate. So which is the perfect answer for this? Can anybody guess? The answer is maximize. The passive buy and hold investor is typically looking to maximize the income generating properties of bonds. We have another questions like that. The main objective of indexing a bond portfolio is to provide a return and risk characteristics closely tied to the dash. Option A, targeted index. Option B, consumer index. Option C, price index. Option D, economic index. Can anybody guess which is the right answer in this particular slide? The right answer is targeted index. The main objective of indexing A bond portfolio is to provide return and risk characteristics closely tied to the targeted index. Number 3. Dash implies that a portfolio is invested for a defined return for a specific period of time regardless of any outside influences such as changes in interest rates, that is implies that the portfolio is invested. Option A, purification. Option B, pure maximization. Option C, pure immunization. Option D, implementation. Which is the right answer for this particular question? The right answer is C, pure immunization. Likewise, we have another question. The purest form of immunization would be to invest in a dash and match the maturity of the bond to the date on which the cash flow is expected to be needed. Number A, there are four options available for this, filling this particular blank. Zero coupon bond. Number B, multiple coupon bonds. Option C, increased coupon bond. Option D, single coupon bonds. Can anybody guess? The right answer is option A, zero coupon bonds. Similarly, we have another question. The goal of Dash is maximizing total return. Along with the enhanced opportunity for returns, obviously comes increased risk. We have four options for filling this blank. A, zero bond strategy. B, active bond strategy. C, quasi bond strategy. D, discount bond strategy. Which is the right answer among these four options? The right answer is B, active bond strategy. Like that, there are so many references are there and books are available on this particular concept. You can go through the references where you can get ample of knowledge with respect to the strategies for managing a bond portfolio. So I wish you all the best and good luck all of you. Thank you for your patience listening and thank you so much.